India, often hailed as the emerging breadbasket of the world, has set an audacious goal to achieve $100 billion in agricultural exports by 2030. Surely, it will be a Herculean task given India's export values as of FY23. The farm exports for FY23 stood at $53.2 billion, a marginal rise of 5.6% from $50.2 billion in FY22. Although India's farm exports have been on a progressive trajectory, the growth has been gradual. The ambition to achieve $100 billion in farm exports is not new. In 2018, the government introduced an agriculture export policy, which aimed to double agricultural exports to $60+ billion by 2022 and reach $100 billion in the next few years. But farm exports fell short of the government's initial aim of doubling to $60 billion by some margin. But why are Indian farm exports struggling to achieve a breakout, particularly in a geopolitical landscape marked by wars and the demand for food grains at an all-time high? Analysts believe that a host of infrastructural issues still plague India's agriculture. Lack of cold storage and modern processing units, as well as logistical issues like efficient transport systems, diminish the value of a lot of agri-products. Consequently, India's farm exports remain heavily dependent on a handful of products, mainly rice, buffalo meat, sugar, and shrimp, which account for almost half of the farm exports in FY23. One of the key hurdles the centre may face in achieving its target has to do with the government's restrictions on shipments to protect the domestic market and manage inflation. In May 2022, the Modi government banned exports of wheat. In September 2022, exports of broken rice were prohibited and a 20% duty was levied on all white non-basmati grain shipments. In July 2023, exports of white non-basmati rice were banned. The next month, a 20% duty was clamped on exports of pre-boiled non-basmati rice too. In May 2022, the government moved sugar exports from the free to restricted category and capped the export volume of the commodity in a year. Since May 2023, exports have stopped completely with no fresh quotas for shipments being issued.
If you ask me, it is very difficult to increase or diversify your basket so suddenly or so swiftly, because the things that India has banned of late are mostly those which are its main agriculture exporting products. If you ban those items which are fetching you the biggest revenue in the international markets, then it is very difficult for you to diversify or to change your portfolio of exports so swiftly. Over a period of time, you should be doing that. Your export basket should be much more widespread. You should be exporting much more those items which you haven't exported, so that even if some item gets banned or some item gets disputed, some item gets curbed, you can rely on the others to boost your export performance. But it is not happening. Your bulk of the exports are 3-4 items.
Experts believe that to achieve the $100 billion agri-exports target by 2030, India will need to diversify its export basket. India is one of the world's leading producers of fruits and vegetables like mangoes, bananas, potatoes, and onions. But its export performance in the global market falls short. Major destinations for Indian fresh fruits and vegetables are Bangladesh, UAE, Nepal, the Netherlands, Malaysia, Sri Lanka, the UK, Oman, and Qatar. Except occasional shipments to the Netherlands or European countries like the UK, India predominantly exports fresh fruits and vegetables to neighbouring countries only. So, what will it take to boost agri-exports and take it towards the $100 billion target?
One way we can do is to improve the infrastructure tremendously, which has been a big constraint, both at the gateways, that is the ports, seaports, as well as internal road structure. Second, of course, that we have to be internationally competitive. Our prices have to be competitive. In marine products, I feel that the exports can go up very fast because recently the PLI scheme has really been very helpful in increasing the infrastructure and therefore the exports. I don't see that kind of jump in cereals exports and sugar exports coming up very fast.
And even if we miss the target of $100 billion, how will any increase in farm exports impact farmer income?
basically exports are a very good way to improve your income of farmers, because it gives you more value for the produce that you're making in the country. Classic example is rice. Rice is one of the, when you were exporting larger quantities of rice, your prices were getting better, your demand was getting created. You were having places where you were growing rice, weren't very big growers of rice. Gradually, you have shifted. You have made that market of yours. Take the case of onion. You have made a good market for one of the biggest players in the onion market. Now suddenly you put a ban because prices in domestic markets are not going down. If you have to have a consistent farming policy on exports, will ensure a better price for the farmers. There has to be benchmark. If it is above this level, then only will impose a price, if a price cap or a ban or an MEP. And if it falls below, we will immediately lift the ban, because so that farmers get the benefit.
India's farm sector remains an essential part of the country's economy, as it contributed more than 18% to the GDP in FY23. The government's ambitious goal to double farm exports in the next 7 years appears challenging at present. Inadequate cold chains and cold storages, along with recurring export restrictions on agricultural items, pose obstacles to India's agricultural export economy. This may at best result in a gradual progression. However, even partial success in this direction would enhance farmers' income and benefit the agri-industry as a whole.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She has ambitions of becoming a brand. Business Standard.